Something has fundamentally changed in the world of global finance. It feels like a line has been drawn in the sand, separating the world we all knew from the one we're just starting to navigate. In this explainer, we're going to break down what this great fracture really means for you, for your investments, and for the future of the entire global economy. Let's dive in. For years, we've all heard the buzzword deglobalization, right? This idea of a slow, kind of deliberate unwinding of global connections. But what's happening right now? Well, it's something else entirely. It's faster. It's way more urgent. You could call it a systemic fracture. So what's the real difference here? Well, deglobalization was a choice. A fracture is a necessity. Think of it like this. A company deciding to move some manufacturing back home. That's deglobalization. A country suddenly being cut off from essential microchips overnight. Now that is a fracture. It's an immediate existential crisis, and it's forcing nations and companies to urgently rethink pretty much everything. And this quote just hits the nail on the head. It perfectly captures the change in mood. I mean, before the last Davos summit, you would have had a hard time finding a single bear on Wall Street. But today, the conversation is all about volatility, rotation, and diversifying away from those old, comfortable certainties. The actual language of the market has changed, almost overnight. Now just take a look at this chart. Back in the 90s, the US and European markets had basically zero correlation. You could hedge your bets, you could balance your portfolio, but today, that correlation is a staggering 98%. So what does that mean? It means when one market zigs, the other zigs right along with it. When everything moves in lockstep like that, managing your risk becomes a completely different and way more complicated ballgame. So in this brand new, fractured world, that old Wall Street saying has never been more true. You've got to follow the money. And right now, the money is making a huge move away from what used to be the world's ultimate safe haven. So why the sudden rush to get away from the US dollar? Well, it's really a perfect storm of factors. You've got growing US isolationism, you've got mounting worries over the national debt, and there's this widespread expectation that the Fed is just going to have to cut interest rates. Put it all together, and the dollar is starting to look less like a safe harbor and more like a risky bet. And this chart right here shows us exactly where that money is flowing. Central banks, the big players, are actively rebalancing their reserves. You can see their holdings in US dollars have dropped down to 40%, while at the same time their gold holdings have surged up to 30%. They're literally voting with their wallets. So the big question is, why gold? Well, Rosenberg Research puts it perfectly. It's malleable, and not just physically, but financially. It's a hedge against pretty much every major risk we're facing in this new era. We're talking inflation, geopolitical chaos, and of course, a weakening dollar. It really is the asset of last resort. And look, this isn't some fringe theory. The big banks are all in on this. As you can see, Societe Generale is targeting $6,000 an ounce. Goldman Sachs is right behind them at $5,700. And Morgan Stanley? They don't even think the rally has hit its peak yet. But this whole fracture, it isn't just about currencies and commodities. Oh no. It's also throwing fuel on the fire of the battle for technological supremacy. Because in this new world order, whoever controls the tech, well, they control the future. And the upcoming big tech earnings reports, they're going to give us our first real glimpse of who's winning that race. In a world where every single company is basically a tech company now, the key question for investors is simple. Who's actually winning the AI race, and who's getting left in the dust? So let's take a look at what Wall Street is watching like a hawk. Okay, first up, Meta. The huge question here is all about the spending. Are they really going to pour over $108 billion into AI this year alone? If so, investors are going to want to see a serious return on that, like better marketing and more user engagement. And there's this rumor floating around. Could we finally see a subscription service for Instagram and Facebook? Then for the software titans, Microsoft and Alphabet, it's all about building the infrastructure for the future. Over at Microsoft, all eyes are on their cloud services and their brand new second-gen AI chip, the Maya 200. And for Alphabet, it's about monetizing. How is that huge deal with Apple and Gemini's gains against ChatGPT actually going to show up in the numbers? And then you have the hardware visionaries, Tesla and Apple. For Tesla, the questions are just massive. What's the real plan for the SpaceX IPO, for the robotaxis, and for that Optimus humanoid robot? Meanwhile, for Apple, it's all about proving its resilience. Investors are going to be glued to iPhone sales, the strength of its supply chain, and the impact of its new AI deal with Gemini. This great fracture isn't just changing corporations, it's literally redrawing the global map. As all these old relationships start to fray, nations are being forced to find new strategic partners to secure their own economic futures. And this slide just captures the whole dynamic perfectly. On the one side, you see the old alliances fraying, with threats of tariffs going up to 25%, and on the other side, you see brand new partnerships forming out of pure necessity. For Europe, diversification is the name of the game, and this new partnership with India is the perfect example. And to give you a sense of the scale we're talking about here, the current trade between the European Union and India is already at 120 billion euros. And that's before this groundbreaking New Deal really even kicks into gear. And look, this isn't just any old trade deal. After 2 whole decades of negotiations, this agreement between the EU and India covers a massive chunk of the world's economy. We're talking a quarter of the entire global GDP. That is absolutely huge. And the real-world impact of this is going to be significant. I mean, just take European cars, for instance. Right now, they face an incredibly high import tariff of 110%. That could get slashed down to just 40%. That's a total game changer for automakers, and it's a really clear sign of how these new alliances are creating tangible new economic opportunities. Okay, so with all of these massive shifts going on in currencies, in tech, in global politics, where should we be focusing our attention to get the next clues about where this is all headed? In the very near future, it really boils down to 2 key events. First, those big tech earnings we just talked about. They are going to be a crucial test of corporate strength and investment strategy. And second, the upcoming meeting of the U.S. Federal Reserve. Now, according to Goldman Sachs, the market is pretty much expecting an uneventful Fed meeting. The consensus is that the Fed's going to hold steady for now, with maybe 2 rate cuts coming later this year. So the real focus, the real drama for now, remains squarely on corporate performance. Which brings us right back to our central theme. The old maps of global finance? They're being completely redrawn. From the flight out of the dollar and into gold, to the AI arms race, to the forging of new economic blocks, the tectonic plates are shifting under our feet. So the crucial question for all of us is this. In this newly fractured world, where will you follow the money?